Thanks so much for joining. This video is an introduction to leases. What are leases? Leasing is an effective way to obtain the benefits of an asset without purchasing it upfront. Yeah, usually if you're an organization and you need certain assets because you need to use them, you pay for those assets. If you need cars for your car park for your employees, you could buy those cars, give them to your employees, and they could drive the cars. An alternative, however, rather than just buying the asset right away, is to enter into a leasing contract, which means that you have the right to use the asset for a period of time and then you pay for it. There are two parties to such a contract. First party is lessee, the party who uses the assets and pays for it. And the second party is the lessor. That's the party who initially owns the asset, gives it to the lessee, grants the right to use it, and then receives the payment. Yeah, so lessee and lessor, these are the two contract parties. There are a few general requirements for a contract to be a lease contract. You need to identify a specific underlying asset. You can't just be very vague and say, oh, give us everything. The contract needs to give the customer the right to obtain all the economic benefits. So if you have a lease agreement with Volkswagen or BMW and you lease a car, then you can do with the car all the economic benefits of driving from A to B. It's yours. So you as a lessee, you have the right to the economic benefit of that asset during that term. And lastly, you give the customer the ability to direct how and for what objectives you use the asset. So again, if we are talking about this car, the lessee has then the right, like the employee has then the right to drive with the car for whatever reasons. The company, in this case Volkswagen or BMW, cannot say no, you can only drive from here to there, this is what you can do, you can only drive at night or during the car. No, because under a lease contract the lessor gives away those rights. There are a few advantages why parties or companies enter into lease agreements. You need less cash, no upfront payment, which makes sense because you are leasing, you're not paying it. It's cost effective. Cost effective, why? Because it's a kind of borrowing. Yeah, if there's something happening for the lessor, you can just repossess the asset. So it's actually a good way for the lessor. You give the asset away and you get money. And then lower risk. Lower risk compared to full ownership. As said, usually there's a contract term, a few years, and then depending on, especially when we talk about financial years, maybe you obtain or you purchase the asset after the lease duration. But usually because you don't need to pay the asset upfront, there's less risk. Very important, and we don't go into accounting details, I will do this in another video. There are two types of leasing. One is called finance lease and the other one is called operating leases. In general, leases that resemble a purchase are classified as finance lease. All others are called operating leases. Again, think about the car. If you have the intention to buy the car at the very end of the lease term, There are some other requirements which I will discuss in a bit. It's called a finance lease as it's purely to use it for operating purposes and you don't intend to purchase it at the very end. It's called operating lease. There is a requirement. There are five steps which are quite important. First, leasee, or the lease, not leasee, the lease transfers ownership of underlying asset to lessee. That's what we said. The lease, the contract, transfers ownership of the underlying asset to lessee. Lessee has an option to purchase the underlying asset, and it is reasonably certain the lessee will do so. 3. The lease term is for a major part of assets useful life. Again, car company, if you just lease the car for 6 months or 1 year, it's different than if you lease the car for a major part of the car's useful life. 4. The present value of the sum of those lease payments equals or exceeds substantially all of the fair value of the asset. So present value lease payments greater or equal fair value of assets. Yeah, so if you, as a lessee, if you, during those contract terms, if you actually pay, because of those lease payments, if you pay basically the full amount of those assets or more, then this is a criteria as well. If you only pay a little bit because you only lease the asset, the car, for 6 months or 1 year, then the entire lease payments will potentially not be equal or more than the fair value of those assets. And the asset, the underlying asset, has no alternative use to lessor. So the lessor doesn't need the asset. And the criteria is, if any of those 5 criteria are met, it's a finance lease. Any of those, because then we talk about transfer of ownership. It looks like a purchase. Lease term major part, you have already paid under 4, you have already paid more than the value of the asset. The lessee has an option to purchase, or the lease actually transfers ownership, then it's called finance lease. If none of those 5 criteria are met, then we call it operating lease. Yeah, and this is true for both IFRS and US GAAP. Yeah. Last topic I want to cover very briefly is reporting, and we don't go into detail, but there are 2 ways to look at. First, you need to look which party are you talking about. Are you talking about lessee? And then you need to think about, are you looking at IFRS or US GAAP? For IFRS, there's only one accounting standard for all leases. There's no difference for whether it's a finance lease or an operating lease. US GAAP, however, distinguishes between finance leases and operating leases. And then if you do the same For the lessor, the other party, then again IFRS and US GAAP. And then here the difference is that even or also IFRS distinguish between finance, leases and operating, leases and US GAAP as well. Yeah, finance lease and operating leases. One last thing, just for completeness, from a lessee perspective, there is an accounting exemption for certain lease contracts, and both IFRS and US GAAP have those under. So for example, if the lease contract is less than 12 months or less, then it's exempt. You can directly expense those lease payments on a straight line basis. So you can directly expense, you don't need to do lease accounting. And then for US GAAP, no, that's not correct. For IFRS, in addition, you have the exemption of low value assets. Low value assets up to $5,000. Yeah, sales price. This is only applicable for IFRS. Only the 12-month contract term accounting exemption is applicable for IFRS and US GAAP. Good. I hope you found this useful. I will do another video where we actually go through step by step into the accounting treatment for every special case. I will do this at a later time, but for now, I hope you found this useful. Thanks so much for listening. Talk to you later. Bye bye.